Intermediate Accounting, Chapter 4, Reporting Financial Performance. Chapter 4, Reporting Financial Performance. After studying this chapter, you should be able to 1. Understand how firms create value, manage performance, and communicate useful information to users. 2. Understand the concept of and be able to assess the quality of earnings and information. 3. Understand the differing perspectives on how to measure income. 4. Measure and report results of discontinued operations. 5. Measure income and prepare the income statement and the statement of comprehensive income using various formats. 6. Prepare the statement of retained earnings and the statement of changes in equity. 7. Understand how disclosures and analysis help users of financial statements assess performance. 8. Identify differences in accounting between IFRS and ASPE and potential changes. Reporting financial performance. Performance, business models and industries, communicating information about performance, quality of earnings and information. The statement of income and the statement of comprehensive income. Measurement of income, discontinued operations, presentation. The statement of retained earnings and the statement of changes in equity. Presentation of the statement of retained earnings, presentation of the statement of changes in equity. Disclosure and analysis. Disclosures, analysis, non-GAAP measures, other key measures. IFRS ASPE comparison. A comparison of IFRS and ASPE, looking ahead. Statement of financial performance. The report that measures the success of a company's operations for a specific time period has many names. Statement of income or earnings, income statement, ASPE, 2 versions under IFRS, 2 separate statements, a statement of profit or loss, and a statement of comprehensive income, or 1 combined statement, statement of financial performance, per the newly issued IFRS conceptual framework. Business models. The basic business model identifies 3 activities: financing, obtaining cash funding, investing, use of funding to buy assets and invest in people, operating, use of assets and people to generate profits. In performing these activities, companies are exposed to different levels of risk and are given different opportunities. Value creation is finding the optimal balance between managing risks and taking the right opportunities. Market demands a greater return when there is greater risk, the risk-return trade-off. Different industries have different business models, and within industries, companies have different business models. Overview of a business model. External. Obtaining funding. Invest in assets, including employees. Use investments to create value, including generating cash and profits, internal. And financial statements. Communicating information about performance. The income statement helps users understand the business. 1. Evaluate past performance and profitability. Examine revenues, expenses, gains, and losses. Compare results with competitors. Statement of financial position is also useful in assessing profitability. 2. Provide a basis for predicting future performance. Use information about business risk and past performance. 3. Help assess the risk of not achieving future net cash inflows by looking at relationships between the various components of income. Quality of earnings / information. The statement of income / comprehensive income has the following shortcomings. Items are excluded if they cannot be measured reliably. Income numbers are affected by accounting methods used. Use of estimates in measuring income. Financial reporting bias. GAAP is not always optimal. Quality of earnings 1 of 3. Quality of earnings refers to how solid earnings numbers are, two main aspects to consider. 1. Content, integrity of information, sustainability of earnings. 2. Presentation. Earnings presentation is clear and concise, easy to use, and understandable. Quality of earnings 2 of 3. Characteristics of high-quality earnings. 1. Nature of content. Unbiased and objectively determined. Reflects economic reality. Reflects primary earnings from ongoing core activities. Can be correlated with cash flows from operations based on sound business strategy/model. 2. Presentation. Does not disguise or mislead. It's transparent. Understandable. Quality of earnings 3 of 3. Earnings management. Targeting earnings levels and then working backward to ensure the targets are met. Selection of specific accounting policies. Use of aggressive assumptions or estimates. Presentation or results in the best light, rounding up. Increase income in the current year by reducing income in future years, or vice versa. Earnings management decreases quality of earnings. Users should assess the quality of earnings before making decisions. Measurement of income, 1 of 3. Key question, how do we measure income? IFRS generally supports the all-inclusive approach to measuring income. This results in comprehensive income. Comprehensive income includes any non-shareholder transactions that cause a change in equity. Example, unrealized gains or losses on reevaluation of property, plant, and equipment under the revaluation model. Measurement of income, 2 of 3. Other comprehensive income, OCI, equals comprehensive income less net income. Includes unrealized gains or losses on certain securities, certain foreign exchange gains or losses, and other gains and losses as defined by IFRS. Some items are recycled, recognized first in OCI, then reclassified later to net income. Gain on some investments classified as fair value through OCI are first booked to OCI and then booked to net income when impairment or sold. OCI is closed to an equity account on the Statement of Financial Position called Accumulated Other Comprehensive Income, AOCI. Measurement of income 3 of 3. Guidance on OCI from IFRS Conceptual Framework. All items of income and expense should be included in net income except under exceptional circumstances. In principle, all items should be recycled to net income, as long as it results in relevant information that is representationally faithful. ASPE continues to focus on net income as the measure of income. Net income represents revenues and gains less expenses and losses from both continuing and discontinued operations. Discontinued operations 1 of 5. Discontinued operations include separate components that have been disposed of or are held for sale. Components can include, under ASPE, an operating segment, reporting unit, subsidiary, asset group, or operations without assets. Under IFRS, separate major line of business or geographical area of operations, or a business qualifying as held for sale upon acquisition. Discontinued operations are presented separately on the statement of income and comprehensive income net of tax. Discontinued operations 2 of 5. Separate component defined. The business component must have operations, cash flows, and financial elements that are clearly distinguishable from the rest of the enterprise, per CPA Handbook. Separate financial information is critical, so gains or losses from discontinued operations can be measured. The component must be a major line of business or a geographical area. However, what is major is a matter of judgment. Discontinued operations, 3 of 5. Assets held for sale. If a component is not yet disposed of, it must be held for sale. Criteria for an asset to be considered held for sale: authorized plan to sell exists, asset available for immediate sale, active search for a buyer, sale is probable within a year, asset is reasonably priced and actively marketed, changes to the plan are unlikely. Discontinued operations, 4 of 5. Measurement and presentation. Depreciation is not recognized on held for sale assets. Remeasured at lower of carrying value and fair value net of cost to sell. Once asset is written down, subsequent gains can be recognized only up to the amount of original loss. Presented separately on balance sheet. Under ASPE, held for sale asset retains original classification as current or non-current. Under IFRS, held for sale assets generally classified as current. Discontinued operations, 5 of 5. Statement presentation. Income from continuing operations, discontinued operations, loss from operation of discontinued division, net of tax, loss from disposal of division equipment, net of tax, those could also be gains, and then net income. Earnings per share, continuing operations disclosure, discontinued operations disclosure, net earnings per share. Or the amount could be shown as a single line item on the statement of income / comprehensive income with the details shown in the notes. Presentation, 1 of 6. Basic presentation requirements. Illustration 4.7. ASPE per section 1520. Revenue, income from investments, income tax expense before discontinued operations, income or loss before discontinued operations, results of discontinued operations, net income or loss. IFRS per IAS 1. Revenue, finance costs, share of profit or loss for investments accounted for using the equity method, tax expense, results of discontinued operations, profit or loss, other comprehensive income classified by nature showing which will be recycled and which will not, share of other comprehensive income of investments accounted for using the equity method, total other comprehensive income, profit or loss and comprehensive income attributable to non-controlling interest in owners, comprehensive income. Presentation, 2 of 6. Items included in continuing operations. Revenues and expenses, for example, selling an ice cream cone. Gains and losses, for example, selling an ice cream making machine. Unusual gains and losses, these are not typical, offer infrequently. Write down of inventory, foreign exchange, included but shown separately. Discontinued operations shown below income from continuing operations. Any other items that are material and or relevant to understanding the financial performance presented separately. Presentation, 3 of 6. Example of a partial income statement showing continuing operations. Illustration 4.6. Presentation, 4 of 6. Under IFRS, the statement of comprehensive income can be presented either as a single combined statement, includes revenues, expenses, gains, losses, net income, other comprehensive and comprehensive income, as two separate statements, traditional income statement and another statement beginning with net income, adding other comprehensive income for a total of comprehensive income. IFRS does not require the use of the terms comprehensive income or other comprehensive income. Presentation, 5 of 6. Example of a single combined statement of income and comprehensive income. Illustration 4.9, and this is TELUS Corporation. Presentation 6 of 6. Example of a separate statement showing other comprehensive income and comprehensive income. Illustration 4.8. Single-step income statement, 1 of 2. Presents only 2 groupings, prior to income before discontinued operations. 1, revenues, including gains. 2, expenses, including losses. Income tax expense often reported separate from expenses as the last item in determining net income. Advantages. Simplicity eliminates classification problems for revenues and expenses. Disadvantage. Oversimplification, less detail. For example, operating and non-operating activities are reported together and cannot be distinguished. Single-step income statement. Example of a single-step partial statement of income and other comprehensive income. And this is Great Canadian Gaming Corporation. Multiple-step income statement. Operating and non-operating activities are separated. Matches costs and expenses with related revenues. Advantages. Highlighting regular and irregular activities allows for greater predictive value, assesses future earnings, and a feedback value, assesses past earnings. Provides better detail to compare companies, allows for better ratio analysis to assess performance. Statements for external users have less detail than internal management reports. Multiple-step income statement 2 of 3. 1. Continuing operations. A. Operating section. A report of the revenues and expenses of the company's principal operations. Sales or revenue. A subsection presenting sales, discounts, allowances, returns, and other related information. Its purpose is to arrive at the net amount of sales revenue. Cost of goods sold. A subsection that shows the cost of goods sold that were sold to produce the sales. Selling expenses. A subsection that lists expenses resulting from the company's efforts to make sales. Administrative or general expenses. A subsection reporting expenses for general administration. Multiple-step income statement 3 of 3. Non-operating section. A report of revenues and expenses resulting from the company's secondary or auxiliary activities. In addition, special gains and losses that are infrequent and or unusual are normally reported in this section. Generally, these items break down into 2 main subsections. 1. Other revenues and gains. A list of the revenues earned or gains incurred from non-operating transactions and generally net of related expenses. 2. Other expenses and losses. A list of the expenses or losses incurred from non-operating transactions and generally net of any related income. C. Income tax. A short section reporting income taxes on income from continuing operations. 2. Discontinued operations. Material gains or losses resulting from the disposition of a part of the business, net of taxes. 3. Other comprehensive income. Other gains and losses that are not required by primary sources of GAAP to be included in net income. This section includes all other changes in equity that do not relate to shareholder transactions, net of taxes. Condensed income statement, 1 of 2. Expenses are reported on the income statement in group totals. Details of the expense groups are included in or on supplementary schedules. Provides the advantage of a concise, understandable income statement. An example of trade-off between understandability and full disclosure. Reduces information overload. Condensed income statement 2 of 2. Example of a condensed statement of comprehensive income with a sample supporting schedule. Illustrations 4.13 and 4.14. Presenting expenses. Nature versus function. Under IFRS, analysis of expenses must be presented based on either nature of expenses, for example, purchase of materials, transportation costs, employee benefits, depreciation, etc., or function of expenses, for example, cost of sales, administrative costs, etc. Choice should result in information that is more reliable and relevant. No similar guidance under ASPE. Which method is better? Most companies use some combination of both for presentation. Intra-period tax allocation refers to the allocation of income taxes within a period. Relates income tax expense to the items being taxed. Certain irregular items on the income statement are reported net of tax. Specifically, income tax expense or benefit is calculated and presented separately for the following. 1. Income from continuing operations. 2. Discontinued operations. 3. Other comprehensive income, although IFRS allows for either net of tax or before tax, with one amount shown for taxes related to all items. Earnings per share, one of two. Earnings per share, EPS, is considered a key indicator of a company's performance. Indicates dollars earned per common share. It does not report the dollars paid or to be paid per common share. EPS based on earnings before discontinued operations and EPS based on net income must be shown on the face of the income statement. EPS based on discontinued operations may be disclosed in the notes to the financial statements. Earnings per share 2 of 2, calculated as net income less preferred dividends divided by weighted average of common shares outstanding. Earnings per share is subject to dilution or reduction if issue of additional shares is possible in the future. For such situations, both basic EPS and diluted EPS are presented. EPS is less relevant for private companies. Shares are closely held, so ASPE does not require disclosure of EPS. Retained earnings statement, ASPE, 1 of 2. Net income or net loss, declared dividends, both cash and share dividends, correction of prior period errors, changes in accounting estimates, and retroactively applied changes in accounting principles impact retained earnings. Changes in accounting principle generally recognized through retrospective restatements. If prior period statements are not restated, opening retained earnings would be adjusted net of tax. Companies following ASPE usually prepare a separate statement of retained earnings, could be included jointly with the income statement. Retained earnings statement, ASPE 2 of 2. Example of a statement of retained earnings, illustration 4.17. So you have the statement of retained earnings, you have the opening balance, the correction of a prior period adjustment, and then the opening balance adjusted. Add in your net income or subtract the loss. Subtract the cash dividends and the stock dividends and get your new retained earning balance December 31st. Statement of changes in equity, IFRS. Under IFRS, you need a statement that shows changes in each component of equity. The statement must include 1. Total comprehensive income, amounts attributed to owners and non-controlling interests. 2. Effects of retrospective application for each component. 3. Reconciliation between the carrying amount of each component of equity at the beginning and end of the period, profit or loss, OCI, transactions with owners. Often prepared in a column form. Analysis of OCI as items on the statement or in notes. Statement of changes in equity, IFRS. Here is an example of a partial statement of changes in equity for Camco Corporation, illustration 4.18. Disclosure and analysis, 1 of 3. Disclosure. Notes are a great source of background and explanatory information. They're cross-referenced to the main financial statements, and they should include the accounting policies, the sources of estimation uncertainty, information about the capital of the company and how it is managed, and general information including dividends, legal form, country of incorporation, description of business name of parent company, other information required under the full disclosure principle. Disclosure and analysis, 2 of 3. Analysis. Financial analysis and investors assess quality of earnings. Certain presentation formats assist users. Look for and analyze accounting policies, aggressive, soft numbers, notes to financial statements, unrecognized liabilities, asset overstatement, measurement uncertainty, risk, financial statements as a whole, complexity of presentation and language, income statement, percentage of net income from ongoing operations, cash flow statement, cash versus net income, statement of financial position, financing and revenue generating assets, other, environmental factors, competition, strategic positioning, future of the industry. Disclosure and analysis, non-GAAP earnings. Non-GAAP earnings, a measure of earnings consisting of deducting from net income non-reoccurring or non-operating items, e.g. EBITDA, earnings before interest, tax, depreciation, and amortization, allows analysis of operating performance without effects from financing, interest, government, tax, or accounting, depreciation decisions. Intention is to add value to the decision-making process and or more accurately reflect performance or expected performance. Not disallowed, calculations should be clearly disclosed and explained, and measure reconciled to GAAP earnings. Questionable, as there are no standards to ensure consistency and comparability. Companies can decide what to and what not to include in calculations. Typically, EBITDA is greater than reported net income. IFRS ASPE comparison. Income statement, presentation, IFRS mandated list of items, ASPE requirements are different. Guidance on expense classification, IFRS present an analysis based on nature or function, ASPE no guidance, must meet required disclosures. Discontinued operations, IFRS held for sale and liabilities reclassified as current, ASPE held for sale and liabilities reclassified as current or non-current. Other comprehensive income, IFRS. Comprehensive or net income must prepare a statement of comprehensive income. ASPE, it's not required. Earnings per share, IFRS. Basic and diluted in the statements. ASPE, not mentioned, not relevant to private entities. Changes in equity, IFRS. Statement of changes in equity is required. ASPE, a statement of retained earnings. Accounting changes, IFRS, new policy, reliable and relevant. ASPE, less rigorous testing for reliable and relevant. And that's the end.